This video is about taxes and legal structures. Before I start talking about this subject, since we are talking about legal matters, I just wanted to put up this disclaimer that this is general information for learning purposes about business startup and entrepreneurship, and it's not official legal advice. I'm not an attorney, so I just wanted to make sure and mention this disclaimer before we started this video. Here's the plan for the video. We're going to talk about different types of taxes, and specifically we'll end up talking about income taxes, which flows into legal structure considerations because your income taxes that you pay depend on what type of legal structure you are. And then I'll talk about advantages and disadvantages of some of the main types of legal structures that entrepreneurs want to consider when they're thinking about forming their business. I wanted to start off with just kind of a humorous intro. So if you are a fan of Parks and Recreation, that show, then you know who this is and his feelings about taxes. So regardless of how you feel about taxes, they are a reality, and they vary, based a lot on maybe your political affiliations and how you feel about socialism and capitalism as well. But regardless, it's good to be informed about them, to know what they are, and think about how they're going to affect your business. Let's go ahead and get started. I want to kind of give you guys a little quiz so you can think about some of your current knowledge on taxes that entrepreneurs have to pay. So this is a specific tax for entrepreneurs, and it's a federal tax that the entrepreneurs or business owners are assessed on wages paid to themselves. This is a specific type of tax, and if you aren't sure what I'm talking about, the little image will give you a hint. I love my boss. I'm self-employed. This is called self-employment tax. So because entrepreneurs don't have an employer, they work for themselves, they don't have somebody taking out the Social Security and Medicare, those federal taxes that if you've ever had a job and you don't get your full paycheck. Taxes are taken out first, and one of those is the Social Security and Medicare tax. So if you take out owner's compensation or wages paid to yourself as one of the business operating expenses, so maybe you take it out as salary, then you would have to assess a self-employment tax on those funds that you take out and pay to yourself. Since it's not an employer doing it, it's you doing it. All right, so some additional types of taxes for businesses. If you have employees, then you also have to take Social Security and Medicare out of their payments so that you can then in turn provide that to the federal government in addition to federal unemployment tax. There's also state and local sales tax in most states. So there's a few, Montana, Alaska, that don't have and a few others that don't have a state sales tax, but they can have a local tax at their community. So the local taxes that they require for products and services that businesses sell. So it used to be mostly just products, but since services are such a big part of business today, most states also assess sales tax on services as well, lots of different types of services. And these are taxes that you collect from your customers, so it add up. Generally, you just add that on top of your prices and then submit it quarterly, sometimes monthly, to the authorized agencies. So in Kansas, the Department of Revenue is our taxing authority. Then there is income tax. So this is kind of the big one that gets a lot of talk in regard to different businesses, and there generally are federal and state income taxes. So not every state has income taxes that they have businesses pay on the profits for the businesses, but most do have some sort of income tax. So these are taxes paid on the profit, which you guys know, you go to the income statement to find that net profit. So even if you have a negative cash flow, because your cash flow statement, your income statement, the income statement's not a good gauge of your cash flow, you still have to pay income tax on the profit that your income statement shows. All right, so this is a big consideration for businesses. And specifically, they vary by legal structure. So there are really two big categories of business legal structures. You are either a pass-through entity when it comes to income taxes, a pass-through entity, or your C corporation, which experiences double taxation. So if you're a pass-through entity, the reason it's called that is it means that all the business profits that you show on your business income statement, they are not taxed at the corporate level or at the business level. You don't pay a business income tax rate on that money. Rather, it flows through to the owner or owners, and that person or those people pay taxes on that money according to their personal income tax rate, right? So the business profits pass through to the individual owner or owners, and they pay income taxes according to their personal tax rate. Now, that's not the case for C corporations, which if you've heard politicians or you've read different business articles talking about double taxation, we're talking about C corporations here. So C corporations, unlike a pass-through entity, look at that business profit, that bottom line, and they have to pay a corporate income tax on that money. Now, if you're familiar with recent changes, in December of 2017, the corporate tax rate was reduced from 35% to 21%, which is a big reduction, and that was in effect as of January 1, 2018. So that's what we're talking about here, that corporate tax rate. So that 21% assessed on the business profits if you are a C corporation. And then if any of those profits are paid out to the owners or the shareholders, as would be the case in a C corporation, then those shareholders, when they get that, their portion of the profits paid to them, they have to also pay taxes on that money according to their personal income tax rate. So the same pot of money can get taxed twice. Once at the corporate level, according to that tax rate, and then once at the shareholder level, according to the tax bracket that shareholder is in. That's what the double taxation means. And we'll talk about that when we look at legal structures as well. Now, how to avoid tax problems. Here's some tips. Obviously, keeping accurate financial records throughout the year. So remember those sales taxes that need to be submitted quarterly. So doing that throughout the year so that you don't have a mess at the end of the year when you're trying to figure out taxes. So along with that, storing ledgers, receipts, invoices in an organized manner, hiring a tax attorney or attorney as a consultant. And if you do your taxes yourself, you want to save money, there's some great tax software out there that's not crazy expensive, that can be affordable to a lot of entrepreneurs, and often tax professionals can at least review the paperwork, even if you do most of the legwork yourself. All right, so let's look into legal structure considerations. There are three main considerations that I want you guys to think about when you're thinking what legal structure is right for your business. The first one is formalities. And what I mean by formalities is paperwork. So all the business paperwork, the required filings, the fees, the required number of meetings, what you have to do to keep your business a business. Those are the formalities that we're talking about. The second consideration is liability, limitation of liability. So does this legal structure protect my personal assets from my business assets? Are they viewed as one and the same? So it depends what type of legal structure you are. And then joint and several liability, which I'll talk about with a partnership. So if you have a partner and you're part of a partnership and your partner does something for the business, you're jointly liable. So you have to fulfill that obligation just as if you would have done it yourself. Whereas in other structures, there's several liability, and you can kind of limit that to where you're not responsible for what all the other owners do. You're only responsible for maybe your individual investment. And then the third issue is tax issues. Those income taxes is what we're talking about here. And you're either a pass-through taxation entity or you experience double taxation, which is what type of legal structure? Just a quick quiz. You'll want to be sure to remember that. The C corporation is the one that experiences double taxation, and we'll cover that again here in a couple minutes. All right, so let's talk about different types of legal structures. The first one I want to talk about is the most common structure, largely because it's one owner and it's a default structure. So some of the advantages are it's very inexpensive to form and there's no formalities. So you do not have to have specific filings to operate as a sole proprietor. You can just go about your business, selling your products or services, and reporting that on your individual tax return. If you pay attention to your tax returns, you'll notice it'll say like single person, individual, or sole proprietor. So those are key advantages, really why it's the most common structure, because it's a default structure. and it's a single owner. So that person controls all the decisions for the company and gets the benefit of all the business profits as well, because it's only one owner. And you get that pass-through taxation, which is generally thought of as an advantage, and that because the money's not taxed twice. So those business profits pass through the business, go to the owner, and the owner pays taxes on those according to his or her personal income tax rate. Disadvantages are it can be lonely being the only owner. You don't have feedback, someone to bounce ideas off of, which again is why we push networking so much for entrepreneurs to connect with other people to help mitigate some of this. You as the business owner are responsible for the debts and obligations of the business, and you have no limitation of liability. So if the business goes bankrupt, the government, as far as it's concerned, you and your business are one and the same. So there's not that limitation, that protection of your personal assets, which is a big drawback to a sole proprietorship. And there's no continuity of life. So if the owner passes away, then the business ends as well. Partnerships. So this is 2 or more partners, and partnerships are dictated by a partnership agreement. So some key advantages, partners can support each other. So that's in stark contrast to the sole proprietorship. Also, like a sole proprietorship, it's a pass-through entity. So each partner's portion of their ownership, those profits are passed through, and they pay income taxes on that money according to their personal tax rate. So that's not double taxed. And partnerships can own assets, contracts, sue, file bankruptcy, register trademarks, etc. So lots of key advantages. Some disadvantages are obviously partners can disagree, and you are jointly and severally liable. So partnerships are regulated by state law. So each state has different rules for partnerships. So if you don't have it spelled out in your partnership agreement, specifically how situation's going to play out, then it'll default to the state law in your state that you're operating in. So most states have a 50-50 rule for partnerships. So even if you're, as a partner, you've invested 75%, the other partner's 25%, if things go south or if you have a liability, then you're each equally responsible. Okay, so that's something to make sure you're aware of with partnerships. And there's no continuity of life, just like a sole proprietorship. It has to be dissolved or reformed if a partner dies. Corporations, specifically C corporations and S corporations, they can have any number of owners. It's limited for S corporations, but we won't worry too much about that right now. And they are governed by articles of incorporation. Key advantages is you get personal liability protection for the shareholders and board of directors. So this is in stark contrast to partnerships and sole proprietorships. You get, if you've heard the phrase, an arm's length protection. The business is viewed separately from its owners. So as far as liability, you generally are more likely to have your personal assets protected from liability obligations of the business. So that's key advantage. Also, money can be raised by issuing stock to stockholders or shareholders. So you can raise your financing through equity, which is a key advantage. Ownership is easily transferred, and they can exist indefinitely or in perpetuity because a corporation, again, is viewed separately from its owners under the law. Disadvantages are that C corporation profits are taxed twice. So again, it's only C corporations, not the S corporations. S corporations are a pass-through entity. C corporation shareholders cannot deduct losses. So even though they have to pay taxes on the profits they take for themselves, they can't deduct losses on there to reduce their tax liability, their personal tax liability, like partnerships and sole proprietorships can. Founders can lose control if other shareholders own more than 50% of the company. So along with that equity financing, losing control of your business, they're more expensive, and they have the most formalities when compared to sole proprietorships and partnerships. So the filings, the fees, the required number of meetings, and there's a lot of government regulations that apply to corporations, whereas partnerships and sole proprietorships, not as much. Corporate structure is shareholders, often the founders, who elect a board of directors who have fiduciary duties to not have a conflict of interest, to make sure they handle the money well, who hire officers or C-suite, so those chief officers, chief executives, and then they supervise the employees. The last structure is a limited liability company, and the owners are called members under this type of company, which just functions with an operating agreement. This is an excellent choice for small businesses because you get personal liability protection and pass-through taxation. It's a contractual entity. It doesn't have as many requirements as a corporation. There are a few disadvantages here, but for the most part, this is an excellent choice for small business owners.